Hello everyone and welcome to another episode of The Founder Files. Today, I'm changing the guest profile a bit to chat with one of South Africa's most esteemed venture capitalists, Clive Butkow. With over 28 years of consulting experience, a Silicon Valley exit, a VC firm, and more than 10 highly successful startups under his belt, Clive has an absolute wealth of knowledge and experience to share. Although he is the ex-founder and CEO of Kalon Venture Partners and left that to start Conducive Capital now, we're going to go deep into his experience at Kalon and how they scaled multiple software startups globally. In this podcast, the conversation is split into two halves. In the first half, we go deep into venture capital, where we talk about the industry and business model of VC, how it actually works, what VCs need to be successful, and why it's such a difficult business to run. Clive shares his vision for the VC industry in South Africa and how he plans to shape it. He also discusses his views on what makes a startup an ideal investment and what he's seen over and over again that always leads to success. In the second half of the conversation, we talk about how Clive's portfolio companies scaled out of South Africa to achieve revenues of well over $100 million each. He explains how to scale the sales function in a high growth business and what mistakes to avoid. And amongst all that, we unpack valuable principles, strategic concepts, and leadership lessons that any founder can learn from. If you want to make sure that you don't miss any value-filled episodes like this one, then make sure that you're following us on your preferred podcast platforms and on social media so you can keep getting practical stories and insights from successful and relatable entrepreneurs like Clive. But for now, buckle in for an absolutely wild ride with an absolute maverick in VC and entrepreneurship. Ladies and gentlemen, Clive Butkow. Welcome to The Founder Files, the podcast that's like eavesdropping on a conversation with a successful entrepreneur over a fireside chat. Join me, Cameron Coots, through this unique experience of unfiltered stories and insights from scaling founders around the globe as they share their ups, downs, and everything in between. Clive, welcome to the Founder Files. This is the first proper time I'm going to be getting the perspective and input from someone who's been so successful in VC onto the podcast. So just as a founder of multiple VC firms yourself now, and seeing so many founders scale and succeed and how we're going to grow, I just can't wait to get your insights and share that with the audience. So thank you for being on the show and welcome.
Yeah, thanks, Cameron, and appreciate the opportunity. And good morning and welcome to your listeners.
So just to kick off with a bit of context, right? So I mean, predominantly today we want to be chatting around Kalon Venture Partners, which we know that you've left. You're the ex-CEO and founder of, and you've started Conducive Capital. But I think I just want to ground it in terms of understanding. Although this might seem like an obvious question to many, can you just explain the business of VC and how the business model works, and if there's any difference between what you did at Kalon and what you're doing now at Conducive?
Yeah, definitely. So just the context, I've been involved in investing for about 40 years now. When I was at Accenture, I built a company in Silicon Valley. We exited the company in Silicon Valley. This is a long, long time ago. Always been an entrepreneur since I was a kid. So my dream was always to go into venture capital. And, I think after 5 years of Accenture, I thought, let me do it now. And I was investing through Accenture. So I just stayed. And I lost the 28 years when I just said, that's it. If I leave it in longer, I'm never going to start my own South African venture capital company, which is what I wanted to do. So I left in 2012 to form, as you said, the founder and the CEO of Kalon Venture Partners. This was still under the auspices of Section 12J, which was a tax deduction from the receiver of revenue. So I started that company, built a board, raised about $250 million. We raised about 257 million rand. During that time, we made 11 investments into very disruptive software tech. So our investment mandate, when our investors, we had about 600 investors that you could call them the LPs that invested in the fund, were investing in a software tech business. We weren't investing in anything that was capital intensive, hardware businesses or working capital, whatever it might be. It's very low capital requirements, software technology businesses, what we invested in. So we had one unfortunate fall off the cliff. It was a very unfortunate situation. I will just share with that for a second because I think this is some of the challenges the VC faces, was where the company was raising $5 million. We were putting in just over $1 million, and two other VCs were putting in $4 million. This was during COVID. And we had got, I had, as the CEO, I had a commitment from the other two investors that they were going to come in. They had already celebrated with an investing company that they were coming in. And so we put our $1 million in, or just over $1 million in. Then unfortunately, the one lady who was the founder of the one company passed away from COVID, and the LPs pulled their capital. And the second founder, who was a Cape Town-based VC, just pulled their capital at the last second as well. So we had put our capital in. This company, unfortunately, needed the $5 million of cash runway to get to cash flow break even. And literally after a few months, the money was gone, and there was nothing we could do. So we lost that money, and it was a great learning lesson. Never do it again. Until the money's in the bank, the money's not in the bank. As much as, other VCs will tell you they're going to co-invest. I've heard that story. I haven't got a little spot here that says stupid, and I will never, ever do that again. But it was a great lesson for me. I'm a learner. I love learning, and you only learn from failure. Failure is the best teacher. So that was the one that failed, but fortunately 10 of them are mostly very successful to successful. And when I talk about very successful, I'm talking about, a company like an example, Ozo, which is, we came in at a number, and they raised then $48 million I can't tell you the exact numbers, but a much larger number. I think it has been in the press. And that was about a 10, 15x return on our capital. We didn't actually exit at the time, but it would have been about a 15x return on our capital after just a couple of years. So these are the type of successes. The next company I'll give you an example of was a company called Senmark, a cybersecurity company. When we invested, and this is not confidential, but when we invested, they were about a 10,000 Rand a month company. Had a couple of clients, maybe two clients in South Africa. I met the team, unbelievable team. They had everything I look for in a team. I'll talk about maybe my 5 C's I look for we'll talk about that later. They had every one of those C's, every attribute about their company was investable, made a nice investment into the company. And they're raising capital now roughly, I just rounded up, about 50 times more than what we came in at the time. So they're now in about 20 countries around the world. They're doing significant revenues. GPs running at 90-95%. Love high GP type companies. Typical software company, 95% GP. So these are just two of the examples. Another one is a company in the AR, ML, computer vision space, which is working in the automotive and insurance space. Again, we came in. The company's really starting to get unbelievable traction. We're looking at an M&A opportunity at the moment. I'm actually working, even post-Kalon, I'm actually working with this company to help them drive this M&A process to hopefully get an outsized return again. So we have some great companies. I won't go through all the companies. We've invested in great companies. I think for you entrepreneurs, the hardest thing about being a VC is actually picking winners, because everyone can write a check, and if it's Kalon or Conducive, we weren't check writers. We're not there to put financial capital in. We're there more for mentorship capital, where we can advise you how to go from $0 to $1 million, $1 to $10 million, $10 to $100 million. I've been there, I've done it. I've done these sort of things, and I've realized it's a fundamentally different skill. We're going from $0 to $1 million, from 1 to 10, 10 to 100. And so these are the type of things, mentorship capital, then human capital. We have access to unbelievable talent. Through my days of 28 years of Accenture, I literally know so many people that are entrepreneurial, that are experts in their field, that we could hire into these companies. And we've actually helped hiring in all the companies. I actually personally do some of the interviewing to make sure there's a lot of blind spots we've all got when we interview, but I've interviewed thousands of people, and I help the entrepreneurs or founders in the interviewing process. And the last one is relationship capital. We've got so many relationships in South Africa and all over the world, from my team in Conducive Capital, the team at Kalon, not just my relationships, but everyone's relationships, where we can open doors to the entrepreneurs to help them. So I think it's very important to understand for an entrepreneur, if you are looking for capital, all the money might look green, but it's not the same. Every bit of capital is very, very different. So from high-touch capital, I'm talking about now, where it's about impact capital, where it's about a lot more than the money, to just taking money from someone. Because all they're going to do is they're going to rock up at your board meeting. Maybe they'll look at their Rolodex and see if they can remember your name. Maybe not. They can't remember your name. But that's the extent of what they're going to get involved every 3 months at your board meeting, if they're on the board. If they're not on the board, they won't get involved at all. You'll never hear from them, and they're completely a silent investor. Very passive. So we're a very, very active investor. We get involved. I'm literally on the phone. I was on the phone weekly, monthly, sometimes even daily. So a lot of the companies I'm on the phone daily. How's it going? Where can I help you? Can I get involved in sales? Ran strategy sessions, ran, sales structuring, operating model sessions, technology and operations, marketing, et cetera, product design. So whatever it was, we got involved with a team in helping these investing companies, just so not questioning what the entrepreneurs were doing, but just maybe looking at, something from a different perspective. Sometimes we've all got blind spots. I have mine, and every entrepreneur's got their blind spots. And we try to help them see their blind spots and just say, maybe not tell them what to do, but maybe an alternative, you could look at something like this because this worked for me in this company. And often, when they take a left turn, that left turn is a pot to a pothole, and a right turn is to riches. And you can just help them maybe see a different perspective of where their company should go. So I think the most important thing, besides all the other things I've spoken about, relationship capital, human capital, mentorship capital, and financial capital, is actually the business building capability. I think South African entrepreneurs are great. They're very visionary. They're very bright. There's an incredible number of very, very bright entrepreneurs. But a lot of them have never done this before. It's the first time they're doing this. Mm. And if you're a sports fan, I'll talk about the rugby match South Africa and Portugal the other day. And, you're the first time player. You don't know if the ball's going to be passed on the left or going to be passed on the right because you haven't been there before. And a lot of entrepreneurs have never seen it before. They don't know how to raise capital. They don't know how to scale from 0 to 1. What should the operating model look like? What should the structure look like? When do you start hiring specialists as opposed to hiring generalists, which is when you start a company, you're a bunch of generalists. When should you start turning for hiring? You're swimming in multiple lanes. When should you start swimming in one lane? That you're either doing crawl or backstroke or breaststroke. Just one thing and focus on one thing opposed to trying to focus on all and becoming a jack of all trades and a master of none. So that's what we did in Kalon. We're looking at about a 30% IRR. I mean, things are, they really are looking good. I did leave this 6 months ago, so I'm not fully up to date where it is at the moment with a number of the companies. A number of them I am still involved with, so I am aware they still, they really are still very, very successful. And and subsequent to that, we launched Conducive Capital. I launched it with one of the co-founders of OZA, a guy called Mitchin Adams. He's a software engineer, great technical guy. So he's the one co-founder. We've just found a third co-founder. She's been involved in building big technology companies, Mabeti, and she's currently at Vodacom, and she's joined us. And then we've got a CIO who is an external bank guy who's joined us as well. So we're in the process of raising capital. We've got a lot of soft commitments. We're having good conversations with a number of LPs, but it's how long is a piece of string when we'll actually raise that capital. Very excitingly, we've built a good brand for ourselves. We're really well known out there as Conducive Capital, and we're seeing some exceptional deal flow. The pity is we haven't got the capital yet to invest in the deal flow, but we might get some, warehouse deals through some of our investors, and there's other ways of doing it. So that's just to summarize, what I did at Kalon. I spent 8-9 years there. I've been 6 months in Conducive, very excited about Conducive. We really want our ultimate big, hairy, audacious goal here. Our BHAG is to raise a 1 billion rand fund, but not our first close will hopefully be at about a 300 million close. And we're optimistic, and it's tough out there. I just want everyone to know raising a venture capital fund is really, really tough. It's very tough, particularly in South Africa and Africa. It's very, very hard unless you've been doing this in that same fund for many, many years. But it's tough. But we like tough. If it wasn't tough, everyone would be doing it, and we wouldn't be doing it then. So it is tough, and we enjoy that. But I've got an amazing team that's supporting myself in raising this capital. We're having some great conversations, and really looking forward to launching Conducive Capital with a closing of our raise, and then starting to make a few investments. And the investment mandate for us is, at Kalon, the investment mandate was probably 20-30% at early stage, like I spoke about Senmark, very early stage. Quite a few of them very early stage at 10,000 Rand, in revenue. And then we had 10-20% in early stage, 60-70% in growth, Series A, pre-Series A, didn't go into B, and then 20% at later stages. And that would more be maybe a little small follow-on in B and predominantly in an A. In Conducive, our investment mandate is pretty much the same. We might touch about 10% in the earlier stages where you've got a phenomenal founding team. They've done this before. They've made money. They know how to make money. They've got a great idea. I can, again, talk about the criteria we look at. And then most of it will be going to growth rounds. It will be Series A, Series B, probably leave the Series A, and it will be a syndicated investment in Series B. Unlikely we're getting to Series C just unless we raise the 1 billion. Then obviously we can put in a bigger check, and we'll go into Series C as well. So we've learned a lot of lessons on Kalon, and we're taking all those lessons and applying them into Conducive Capital, where, as I said, I've already found the team, and a very exciting time for tech entrepreneurship in South Africa and Africa. It's really exploding. I just saw the numbers for the first 6 months of this year, and it's the highest number that's been. I'm not sure the numbers are accurate or not. I can't comment on that. but I just read the numbers. It was the SAFCA report, and they show that 3 billion rand has been raised in the first 6 months into venture capital in Africa,
Sure.
which is a phenomenal accomplishment.
So much for the winter.
Absolutely.
So Clive, yours. Thank you for the context, and you've given so much there, because it's like you've literally laid the groundwork for everything we're going to be chatting about in the podcast now. And I think the first point there is in terms of VC, to founders, it's so important to really pick the right investor. And this will be very obvious to a lot of founders that have already received investments and worked with investors before. But there's a lot more than just the capital that you're bringing. And I think the people that are coachable are the ones that realize that. And I'm pretty sure that's one of your 5 C's, is the fact that it's like, if you're coachable and open to it, that's when you change your mindset to what kind of investor you're looking for, because what they bring is a lot more than just the capital. Because at the end of the day, and like this is what I want to actually chat about now, just to really demystify VC and be honest about the business, is that although you are an investor, you're in the business of building businesses, right? Because that's the only way that you essentially make your money. And the business model is almost always the 2%, 20%. So the 20% management fees is essentially your operating expenditure and how you're able to manage the business. And then your profit comes from the 20% profit that you make on the exits of those businesses at the end. And I think a lot of people don't realize that that's a very hard business model. It's very constrained. The smaller your fund, the less you can do for the founders. And the more that you have to wait. And also the smaller the fund, the earlier stage investment, the greater the risk. I think it's really tough. And I think the fact that you've been able to have all those successes and have that one, we say failure, I think maybe mistakes are a good word that you learn from. And the point there is never celebrate till the money's in the bank. I've got the same mentality now. Is like, you can make a deal, you can have a signed proposal, but until that invoice is paid, you don't celebrate it. Same thing with clients. I think same thing for you in terms of co-investing. So there's without essentially just summarizing and repeating everything that you've said, because there's so much depth I want to get into. I just want to just unpack the VC business model a bit and just explain, what are the challenges you've found with managing that 2%, 20% business model, trying to exit from these businesses, and how you essentially make that profitable in a way that you can keep adding value to founders. What have you learned in that journey?
Let me just summarize what you've said there, so everyone can understand that. So typically in the venture capital model, it's the general partners, the people that actually run the fund. So like myself as managing partner, Mitch, Matebi, and Samir, the people that actually run the fund are the general partners. So we have fiduciary responsibility, and we have a risk of liability if we do something wrong. The LPs, which you would have heard about, the local partners, are the investors. So they're the people that put the money into the fund. So we're speaking to about 5 or 6 local partners now, and they might put 50 million, 100 million each, and they will be the LPs. Typically, the way the LPs work and the returns that they want, first and foremost, if they put, let's use numbers, if they put a 300 million rand into our fund, I'll come back to the economics now. We have to pay them back the 300 million before we take any money. And then there's typically a hurdle rate, which might be, say, an 8% hurdle rate. So we have to pay them 300 million plus the 8% hurdle rate before we take a cent. Once we've paid them back the initial capital that they've invested plus the hurdle rate, we then start sharing on an 80-20 basis. They take 80%.
Sorry, Clive, just to unpack that before you, just the hurdle rate from my understanding is the fact that it's like, how is it that we can guarantee that this is a better investment than just putting it into a savings account? Right, so it's almost de-risking it for them in terms of a minimum inflation-beating investment just in and of itself before we can even think about returns.
That's correct. Yeah, that's exactly correct. So not all of them have a hurdle rate. Some are 10, 12%, some are 5%. It all depends on the negotiation you as a GP have with your LP. But you're absolutely right. It does protect them that they make sure they get some form of return before you start sharing in those returns. So once you've hit the hurdle rate and the 8% return, it's interesting. You only get 20%. So let's take an example. I like to use examples. Of that 300 million rand fund, and I'm going to forget the hurdle rate for a second. Let's just say you deliver 900 million, which is a 3x return on capital. Put in 300 million, you get 900 million back, 3x return on capital. That's a very, very good return for a VC. But let's take the number. So the balance of the 300 million, which you've paid them up front, there's 600 million rand left. So you get 20% of the 600 million, which you can do the maths, which is 120 million. And then they get the 480 million, which is the 80% of the fund. And then you divide, of the 120 million that you get, you divide that amongst your your partners that have got a percentage of the carry. So I have a certain percentage, Mitch has a certain percentage, Mabete has a certain percentage, and we'll share in that in the 20%. But so you can work out that 120 million sounds like a great return, but that's an exceptional outcome, which is a 300 million to a 900 million, which is a 3x. Often you only get...
And that's over a 5 to 10 year period.
That's more likely a 10-year period, even than a 5-year period.
Yeah.
You're very lucky if you do that in 5 years. You do that in 10 years. And, there's Peter Thiel calls it the power law. And so to explain the power law to your listeners, basically what we're saying is you need to get 1 or 2 absolute home runs. So when we make an investment, we look at nothing less. If we don't see that we can return 10x return on capital. So we put in $1 million at a 10 million valuation, that business has got to be worth 100 million. And our 10% is worth 10 million if we put in $1 million. So that's the 10x return on capital. That's assuming there's no further dilution, there's no further rounds, et cetera, et cetera. If we don't see a 10x return on our capital, we won't invest. A lot of people say, well, what percentage equities you want? I say, I don't care what the equity percentage is. I care about how much that equity is worth, not how much I get. If it's 20%, 10%, 1%, 5%, it doesn't matter to me. I want to do the math and say, yes, I think with the size of the market and with these blah, 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 I can make a 10x return on capital. I don't really want a 10x return on capital because the power law says I want at least one of my companies will give me a 100x return on capital. And that 100x will pay for the full fund. So that 100x should return, each and every company should return the full 300 million as per my example. And then everything else that the other 9 companies hypothetically say in Kalon is playing with the bank's money. That's playing with the bank's money. You get 20% of every cent that you sell and that you exit. Whether you exit via secondary capital, is where an investor comes in and they oversubscribe and there's more capital and they buy shares directly from yourself, which is called secondary capital, or you exit via primary capital where someone comes in, invests and buys out the company, or it's a trade exit or wherever it might be, and then you can take your 20%. You get your portion of your holdings, and then you take 20% and give your LPs the 80%. So that's how the business model works, and it's very important for South African entrepreneurs to understand 300 million gives you 2% management fee. It's 6 million rand. Now, after your regulatory issues and audit issues and rental issues, you're not left with a hell of a lot. You're left with 3 to 4 million. You have to build a team on 3 to 4 million. So some of our team have come from 2-3 million rand salaries, and now we're saying, sorry, if you want to join a VC, you're getting involved for the equity piece. You're not getting involved for the salary. It's not a short-term answer, it's a long-term. So they have to help you build your businesses, because if they don't, we're not going to get that one-time return, and we'll make peanuts on salaries. So you don't get rich on salaries unless you raise. If you raise 1 billion rand, you can work the maths out there. If you raise 1 billion rand, 2% of that billion rand is 20 million rand. That's a good amount. You can hire a team of 10, 15 people. You can really, what we try and do is we want to be the Sequoia of South Africa and Africa. Hire people in every single domain. Like we hire sales, we hire marketing, we hire product, we hire finance. So these people in marketing, if it's TikTok, if it's Facebook, if it's Instagram, people that can go into our investing companies and help them with every single aspect of their business. Brilliant UI guys, brilliant UX guys, brilliant product engineers, brilliant, from a sales point of view, chief revenue officers, SDRs, BDRs, and all the different types of people that you need in a sales environment. We would look at hiring that they can go into our investing companies and actually help them. But you can only do that with a big fund. So with a 1 billion rand fund, for me, that's to me is the minimum amount to build a really good fund is 1 billion rand. So the 20 million rand goes a long way. You can pay good salaries to world-class people, and you can hire a very, very good time. We're not looking to make money on the 20 million. I mean, if we didn't spend it, it would be allocated as a dividend back to the shareholders. But that's not the intention. The intention is to provide an unbelievable service. We're a services organization. That's what we do. We service the entrepreneurs that we work with. We service them in terms of helping them build. We service them in terms of, and not just the board roles, knowing, as I said earlier, how to go from $0 to $1 million. They don't understand. You spoke about coachability. Most entrepreneurs don't understand that 0 to 1 and 1 to $10 million and 10 to $100 million, unless they've done it before. It's like playing soccer and cricket. It's not even like playing in the Premier League and playing in the third division. It's a different sport. It is so complex to go from 0 to 1 or 1 to 10. It's completely different from a leadership point of view, from an entrepreneurship point of view, from an operating model point of view, from a structure point of view, from a hiring point of view. It's just fundamentally different. And that's what going back to coachability, the most important criteria we would ever look for, my number one criteria. If they're not coachable, well, then I'm just giving them a check, and we're not check writers. We're not check writers. That's a very small portion of what we do, is being a check writer. We're smart capital. We want to get involved, and we want to help you build your business into a unicorn. And if we can't do that, and one of the challenges you've got with in anything in life, it's not necessarily entrepreneurial, but you don't know what you don't know. And if you don't know what you don't know, you say, well, this is the only way I know. So a lot of entrepreneurs spend so much time defending what they don't know rather than learning what they don't know. And it's so frustrating when you can say, guys, I don't think that left turn is right. Just go a bit central, go a bit right, because I've seen it before. I've got the gray matter. I've got the pattern recognition. You've taken my money to surround yourself with people that have been there before, and then you're not taking our advice. And I have had this. And even in my own capacity, I invest in angel investing. But I've stopped now when it's not a coachable investor. If it's not a coachable entrepreneur, I won't give them a cent, because I know they're not going to listen. And if they're not going to listen, we're leaving it to them. And you're never going to get the right answer at the end of the day. You're going to leave money on the table. So what we do there, if they're not coachable, then they wouldn't be getting Conducive Capital's money, and they're definitely not getting my own personal capital if I invest in an entrepreneur.
So Clive, what stood out for me here is it's way better to be an LP than it is to be a VC. And obviously just want to contextualize this as I still really am learning a lot about the VC and LP world. So forgive this if I'm being a bit reductive or making too many assumptions. But if I was thinking about this based on what you described, I'd almost be looking at, if I'm starting a VC, for this to be a 20-year play. And the reason why is because it's way better to be an LP than it is to be a VC, just because of the returns that you're able to make. And if you think of being an entrepreneur yourself and being a founder of a business and just being a shareholder, how we grow is just reallocating profits and capital into the business to fund that growth. And how this works in your situation is fund one is successful to whatever success it is, and then you get that 20%. We go back to the 120 million that you mentioned. Taking that, distributed across the partners, because obviously you need to get a return from the salaries that you've forgone over the decade that you've done that, and then able to then redistribute the funds into your next fund. And now the difference is, instead of waiting on 20% of that fund, you can get 80% back on that capital by being the LP within your own business. And by doing that, that's how you're able to get outsized returns over time. But it's just reinforcing to me that it's so difficult and requires so much patience, and there's so much risk involved to do this. And the obvious point that you mentioned there is, how do we de-risk this? Having a bigger fund, not only so that we can pay salaries, but so we can get all the capabilities needed to ensure that these businesses are successful. The other way to de-risk it is obviously just to make sure that we're investing not just in the right business, but the right founders. Because it's the founders that are going to build the business at the end of the day. And specifically, if you're early stage, there isn't a business yet. It's a founding team and a product. And so I think that's what's resonated with me. And it's built a lot of empathy for how I think about the general partners of VC firms, because what they're doing in terms of them starting a business is they are acknowledging that I'm not going to be able to generate a significant amount of wealth for a minimum of 10 years, but probably 20 plus. Whilst entrepreneurs of tech businesses, that time frame can be a bit shorter, but the risk on both sides is significant, and you just almost you're playing the game with multiple businesses at once. So I think it's very hard, which brings me back to the question is, like you said, you wanted to start a VC like as long as you've had a career. My question now is why?
Yeah, I think it's, I think there's a number of whys. I mean, one is it's exciting. If you're an entrepreneur at heart and you don't want to be stuck in a corporate environment and you want to help build businesses and learn the different skills it takes, because every business is different. There's no playbook that you can just say, because Ozo worked that way, Senmark will work that way. It doesn't work that way. Yes, there's a lot of that grey matter I spoke about. There is some pattern recognition, and success leaves clues, and you can always, from success, you can leverage that success and your ideas into new businesses. But in all honesty, it's exciting. It's really exciting. But for someone like myself, at my stage of my life with 4 children, etc., if I hadn't made my financial wealth prior to this, I would not have been a VC. Because if I needed that from, and I needed the money, VC is not an asset class I could have been involved with. It's not affordable. I've had long chats with the other guys, and we're looking for ways that we can actually subsidize their revenue
or subsidize their salary, so at least they can get a reasonable salary and come and join Conducive. So we're looking at being a services organization where we can supplement the 2% management fee with some services revenue as well. And particularly initially, if you look at the big funds, and why do people do it? If you look at the big funds around the world, none of them really in South Africa, but where you take Sequoia, where they've got hundreds of billions of dollars, you take 2% of that or 1.5% of that. That's a lot of money. You can be paid $500,000 a year, $1 million a year, which is it's a very respectable salary. So you can do that as a career in parts of the world where they've got these big funds. Also, what they do with the big funds, what's the challenge for us here, particularly for Conducive, is we're a first-time fund. Because I had Kalon as a fund. If I'd raised more money to Kalon, it would have been easier, because then your management fee, you keep on raising new funds. You have Fund 1, and then in parallel Fund 2, in parallel Fund 3. So you've got management fees from each of the different, so you can actually you can have enough management fees to do what we're talking about. You can pay yourself a good salary. You can survive for 10 years without that, with this reasonable salary. You can hire the right number of people. You can hire the right number of skills. But when you've got a first-time fund, like we are really a first-time fund in Conducive Capital, it is very tough on 300 million. As I said, on the billion with 20 million, which is the 2%, you can actually do quite a bit. But I'll go back to the why as well. So if I look to our team, they are so excited about getting to know VC. They're so excited to learn the skills of a venture capitalist. One of the goals of Conducive Capital, and I'm not saying this because it's South Africa, because we recently had an election. We've been saying this since day one when I sold my vision to Mitch and sold my vision to Matebi. I said to them, we want to hire as many black women as we can to grow them into the next generation of black women venture capitalists we can in this country. So in 5 years, I would like to see these women leave us. I mean, it's crazy that I say that, but leave us and go and start their own funds where there's lots of capital in this market. There's no shortage of capital, and they can go raise a 500 million rand fund or a billion rand fund. That to me is my why. That's why I'm doing this. I'm doing this because I can help black entrepreneurs. I'm not only investing in black entrepreneurs, I'm investing in the best entrepreneurs, but hopefully black, women, white, whatever they might be. But actually our team is going to be made up predominantly of black women. And we're going to, and not just myself, but the team, Mitch as well, and I'm going to make a plan whether it's, by design or not by design, whether it's formalized sessions or informalized sessions, to get them involved and really help them become the next level of venture capitalists. Because then I know I've met my why, and that's the reason why I do this. I'm not doing this for money. This is my children's inheritance, and I don't mean to say it in the wrong way, but this is my children's inheritance. My big why is I live in this country, I love this country, I'm passionate about this country, I'm passionate about the entrepreneurship in this country. I'm passionate about some of the talent we see, whether it's black or white, in this country, that want to get to know how to build 10, 20, 50 companies and not one company. So the service I'm doing is really to build this venture capital company, hopefully raise a big amount of capital, and actually achieve that vision of being number one to our entrepreneurs, number two to our investors, and similarly to our employees in helping them really to get to understand this asset class. Because I'll tell you something, Cameron, I've worked with a lot of VCs in South Africa, and there's very, very few that have actually built a tech company before. I exited a tech company in Silicon Valley many years ago. And the amount I learned from exiting that company. So I'm an entrepreneur first, before I'm an investor. I'm an operator. And if I look at Mitch, he's an operator first before he's an entrepreneur. If I look at Matebi, she's an operator first before she's an entrepreneur. So we are the entrepreneurs behind the entrepreneurs. And sadly, in South Africa, we don't have this playing it forward like they have in America. Where America, you get the entrepreneur, they sell their businesses, then they play it forward. They become the VCs, and they can help the entrepreneurs grow because they've been there before and they've seen the road ahead and successfully excludes, etc. We don't have a lot of that in South Africa. There's very few VCs that have been entrepreneurs. Not none, but very few. They predominantly come from a private equity background, actuarial background, accounting background, legal background, but not an entrepreneurial background. And I sit on boards with a lot of these VCs, and I'll tell you, they just don't have the skills. They don't know the metrics to manage this business. Okay, this is an enterprise SaaS business. What's the metrics, the 5-6 things that we absolutely have to manage this business? You have to know that stuff. Because the entrepreneurs have never done this before. They don't know this stuff, and you don't expect them to. But you've got to know it. So I know it, and I can help them. What do we measure at Series A? What do we measure at Series B? What do we measure at pre-Series A? What am I looking for in pre-Series A? What am I looking for at Series A? What am I looking for at Series B? They're fundamentally different things I look for at every single stage of investment. But you have to have actually raised before or gone through this before, I believe, to actually know how to do it correctly. So, as I said, we have a shortage, and sadly, we have a shortage of entrepreneurs, and that's why my passion is to build the next generation of VCs that really understand venture capital. And I'm talking about software tech venture capital. I'm not talking about investing in FMCG or investing in battery technology or solar technology. We're not going to do that stuff. I don't know that stuff. I don't want to touch that stuff. Not my forte. I want to stick to my knitting. I'm good at software technology. I know software technology. It's very capital light, very capital efficient. So that's what we're going to do. So I hope I've answered the why we do this. But it's a long question to a long answer to a short question.
No, it's really painted a picture and a vision for where I can see the entrepreneurial ecosystem in South Africa going. Because, like, something that I've personally struggled with on the podcast and just getting guests is, like, I interview almost exclusively white men. And I think that's the nature and problem in South Africa in general, is the fact that anyone in business leadership, whether it's in entrepreneurship or whether it's in corporate, are usually white men. It's because of the backgrounds, the networks we've been able to get to, the education, the privilege, etc. And I think the point in the nature of that is that's unsustainable, right? It's not going to help equality. It's not going to help equity within this country. And the what you've mentioned now is I can really see this unfolding, is specifically in the VC space, because you mentioned the two parts, right? You mentioned the founders coming and paying it forward, and that's a why that I can really get behind, right? Because that's something that I can imagine me potentially becoming a VC one day. Look, maybe not necessarily with outsized returns of exiting a strategy consulting business, because I think the valuation there is so human capital intensive, but I'm not going to go down that rabbit hole. But the point is, if going down the VC route is really much like I've become successful. And what is it that I enjoy is entrepreneurship, building things, right? The chaos and excitement of, like, growth and success and figuring it out and learning, and how to do that with you, but guide it with you. I think that's what entrepreneurship is. And that really paints the picture of why so many people get into VC. But what you've unpacked for me now is the fact that we need Black female VCs who are incredibly competent at what they do, because look at the population of the country, look at the networks that are available. There is a lot of capital going around. And if you just look at this insular circle that happens with, like, we've got white entrepreneurs backed by white male VCs, and it just kind of sits and perpetuates within the cycle. And there's so much capital that is available within this country that's not being accessed just because it's still, this literally a white men's old boys club. And I think being able to address that by empowering younger Black founders to come through the ranks, help them be successful, empowering them to become VCs, is like that. What you've done is just paint the picture for me is where the entrepreneurial ecosystem should and can go within South Africa, and that I find quite inspiring.
Yeah, I think I just want to just make a point, Cameron. There's no shortage of money or capital in this country. There's no shortage. There's lots of it looking for a home. Trust me, there's lots of it. And it's great, and they're looking to back Black entrepreneurs and Black VCs, and that's fantastic. But there's lots of capital. It's looking for a home. They just want to find the right home in the right neighborhood. That's what you need to do. And from discussions that we've had with our team is, wow, there's a lot of encouragement about what we're doing. What's our big, hairy, audacious goal? What's our vision? There's a lot of encouraging people out there. They want to work with us. So, but I think we're doing the right things. And the litmus test ultimately will be growing those Black women venture capitalists. Because that litmus test to me will be, have we been successful or not? It's not the 3 times returns on capital, the 30% IRR. Of course, that's important, but I take that as a given, that we will return because we know what we're doing. We'll give you a good return of 30% IRR, which is great, but I'm comfortable with that. It's will we actually do more than that? It's not just the financial return, it's the non-financial return. The triple bottom line, how do we actually make a difference in South Africa? How do we create employment? In Kalon, we created hundreds and hundreds and hundreds of jobs, hundreds, through our 250 million rand we've got. And I think, and that to me says it's creating jobs, and hopefully creating jobs for a lot of people that are unemployed right now, not just people moving from one great job to another great job, because that's not actually solving anything. That's not solving a problem. So hopefully we can, and hiring a lot of, people that came from disadvantaged backgrounds, because they're fantastic. The skills out there are fantastic. I mentor 20, 30 Black entrepreneurs all the time. Today I've got 4 entrepreneurs, they're all Black entrepreneurs, part of an organization that mentors them. They started in companies, and myself and a few other guys that have been successful, we mentor them. We do 4 a week. And it's just, I tell you something, that give back is so, so encouraging. When I lie on my pillow at night and I think about those conversations and how we're potentially changing their lives, I sleep well. I really do sleep well. And I'm not sure I'll be able to have this opportunity in other countries. This country is the land of opportunity. It really is. And if just more people would actually be advisors, because there's so much good skill out there. You think that white male person that's had 20, 30 years in corporate or whatever they might be, they know banking, they know insurance, if they could just get out there and be those mentors to some of those young entrepreneurs and help them see the road ahead and help them with domain expertise, I think we could turn this country around. So that's what we want to do in our little microcosm. I know it's just a little microcosm, but we can only do what we can do. We can't change the country, but we can change the country one person at a time, one business at a time. That's what we can do, and that's what we are going to do.
Let's pause here for a moment. If you've made it this far into the episode, it's probably because we're talking about things that you're trying to implement in your business. You found your sweet spot in the market, you've gained momentum, and you've already been through a phase of growth. Because of this, you know that on the outside, growth is super sexy, but on the inside, it's incredibly difficult to achieve and to sustain. So now I've got a question for you. Now that you know the sacrifices it takes to achieve growth, how much time are you currently spending thinking about your direction and your next phase of growth? I bet not as much as you'd like, because you're still in the thick of it. Leading, deciding, pushing for performance, pursuing new opportunities, maybe even thinking about selling the business. See, your story is yours. But this chapter where growth meets complexity, this is when things get hard. Because you can listen to insights from podcasts and stories from people that have been there before, but applying it to your context is a completely different ballgame. So let me help you. If you want to have a 90-minute, no strings attached conversation with me, then head over to Metavolve's website in the description of this podcast below and let me help you navigate this next phase of growth. Because at the end of the day, building a great business is complex, but it doesn't have to be complicated. So I'm going to get philosophical for a second, as I tend to do. But what's unpacked for me is what I find common about people that are highly successful usually frame their thinking around what is the group of people that I want to impact and change and benefit, right? And from least to most successful is I want to benefit myself, I want to benefit my family, I want to benefit my family and friends, I want to benefit my immediate community, I want to benefit my markets and customers and people that are solving a problem, and then the top one is I want to benefit and impact the society that I'm living within. And I think what you've been able to highlight throughout the story that you've given is the fact that it's like that the nature of your ambitions and the size of what you're trying to achieve with Conducive Capital and the impact and the vision that you have for what you're trying to build is not just around what you want. It's got actually almost nothing with what you want to achieve for Conducive Capital. That's almost the means to the end, is achieving the vision for Conducive Capital is to achieve the vision that you have for the VC ecosystem in South Africa. And that is to really take it to another level where it can be more sustainable and it can start maturing and looking like more established VC ecosystems in other nations. And you've just painted the picture of what it is to go there. But the only way to go there in the first place is that what's predominant within your thinking is who is it that I want to add value to and who do I want to impact on? And just the scope of where you're thinking is far greater than I think a lot of people think. And I think that's one of like a core pillar for how successful do I want to be is, well, what's the scope of people that you want to impact in the world?
Yeah, absolutely. One day when I pass on and there's a obituary of me, I don't want to talk about that I made money. I want to talk about the lives that I changed. And that's the most important thing. And it's just unbelievably rewarding. I'm very privileged that I can do that I don't have to go out and work and earn a living. I'm very privileged. But South Africa's got there's so many problems, in all honesty. Africa's got so many problems, and every one of those problems is an opportunity. It's an opportunity for an entrepreneur to solve a real big problem. It's not a vitamin which is a nice to have. It's a painkiller which is a need to have. There are so many challenges in this country and in Africa that there's so much opportunity for entrepreneurs. And I'll tell you something, Cameron, I see these. I go and do talks all over the place, I'm sure like you do. And I get 10, 20 people coming to me after and say, please, can I just have a phone call with you? And won't you mentor me and this and that and et cetera, et cetera. And I'll try and help as much as I can. And I do help. I help a hell of a lot. But just to help these people, and just to see the great minds. There's some unbelievable minds, unbelievable ideas, great teams, but what there isn't enough capital in South Africa. We are short of venture funding in this country. Very, very short. If you look where there's some angel investing, and that's great. Some probably the white males you spoke about. But really at the venture capital funding, I tell you, if you take all the funds and you add them all together, you're not going to come up with a big number if you divide it into dollars. It's really not a big number at all. But there is unbelievable opportunity to make a difference and actually change lives. So we just had more capital that was being deployed to fund managers, and the fund managers can then come deploy that capital into the investing companies. I think we could change this country. We could change this country by the number of people we employ, as I said, by more black women VCs, et cetera, et cetera. But there is not enough venture capital in this country. There really isn't. If you just look at the model again, I want to just go back one so your listeners or your viewers can understand this. If we raise 300 million, let's just say it's a 10-year fund, and we get 2% management fee per annum. Okay, so of that 300 million, we're getting a 6 million rand per annum. If we need management fee to have a team to help build these businesses. So over 10 years, that's a 60 million rand management fee. That only leaves us with 240 million rand of investment capital. When we invest in companies, I will never invest more than 50% of the capital. So that's not even 150 million. It's about 120, 130 million in the first check that I write, because I actually want to hold what we call dry powder in the VC industry. So when I hold that dry powder, the 120, 150 million, then we can actually invest in the next round, because we don't want to be diluted in that next round. We get involved, we back these companies, we spend a lot of time, they really start blowing the lights out, they raise additional capital at a much higher valuation. We want to follow our preemptive rights and actually put more money into the company so we don't get diluted. So even with a 300 million fund, we're talking at most that's going to be deployed about 140 million. So, you might think it's 300 million to deploy, but there's not. For me, as a seasoned venture capitalist, there's 140, 150 at most that I'm going to deploy into my initial check into entrepreneurs.
And I love that point, because it's also it's a part of the naivety that I had just with the nature of the business that I have, is because I know Metavolve can add a lot of value to VCs. But the naivety that I had is I see all these numbers and these funds, and it's like, there's plenty of money to go around. They can definitely afford to pay us. No, they can't, right? The point there at the end of the day is it looks like a lot of money because you look at it at a lump sum. But if you actually play out how the business model works, there's so little money to go around. And that's why every deal is so heavily scrutinized. There's so much due diligence, is because the fact that it's if I'm spending this on you now, it's not around just this check. It's about the 3 follow-on checks that are going to come with this, and then the exit I have to facilitate, and then all the work that I have to do in this. There's so much work. There's not enough capital. And I think what we've really had such an in-depth conversation of really understanding what VC is, the challenges that it has in this country, and the fact that we really need to unlock this. My belief behind this, besides unlocking more funding for VC, is really just to ensure that startups can be sustainable, be profitable, and lead to management and leadership teams within entrepreneurial businesses that can be successful in their own right and start their own businesses as well. And the only way to do that is to make profitable, sustainable, successful businesses. And that's what Metavolve cares about at the end of the day. This is not a plug for me. So I want to segue that part of the conversation now into what we've spoken about. Is I brought up the philosophical point of success. We're not talking about money. We're talking about growth. So Clive, at the end of the day, I want to talk now about how have you managed to actually take, these portfolio companies that you had at Kalon Ventures and take them global, make them successful. Do you have a couple of examples that you can take us through where you took us in, where you got into them at early stages, grew them within the core market, and then took them overseas? Such a big topic, but I'll let you guide that conversation, because I really want to understand how you did it and how they did it.
So I've done it many, many, many times, during my younger years, during my Accenture days of building companies globally. But let me give you examples. Let me use Kalon as an example. So there's 2 ways of taking a business global. I think number one is, I think for entrepreneurs, and I want to talk about the RP first and foremost before we talk about how you take globally into other countries. I think we have to, and Saab hopefully, is changing from red tape to red carpet, because I think there are a lot of initiatives where they're getting Saab involved to create this red carpet for entrepreneurs, from an immigration policy point of view, from an RP point of view, but hopefully they can get the intellectual property off into the likes of Delaware, which is a great investment opportunity, Amsterdam, the UK, Luxembourg. Well, I wouldn't go to Mauritius. For me, is not the place that I would go personally, but that's a personal opinion. But to get that RP offshore, and you do that before your company gets too large. And the reason that's very important for two reasons. One is if you really are going to become the next Apple or the next Amazon, and you want to raise the 10, 20, $50 million, it's going to be very hard to raise it into a South African PDY Limited. Very, very. I'm not saying impossible, but very, very hard. If you look based in Delaware and you're getting American money, you've just made it very, very easy for them. So how do you scale these businesses? One is you get your RP offshore. I think number one, because if you really scale and create a $100 million business, or let's say you want to go to an RPO, you want to go to an RPO, you need to, in 2-3 years ago, you're probably $100 million ARR. If you were a software as a service business, you could probably 10x multiple on revenue. You could probably RPO at $1 billion. You were a unicorn. Now it's changed. It's probably gone up to $150 to $200 million. You can then RPO at that stage. Now, all of us want to get to the RPO stage. So we're probably looking now at getting to $150, $200 million business. And you're not going to get to $150, $200 million business in South Africa. You're just not going to do that. The economy is not big enough to. I say build your business where you birth it. So if you birth it in South Africa, build it here. Get product market fit, get your initial customers, get your initial traction. Fantastic market to get that. But to build a $100 million, $200 million business that you can RPO one day, you're not going to do that. This economy, it's a $400 billion economy. It's not big enough.
I think also just to caveat that with a software business that's got gross profits of 90 to 95%, because doing this in businesses, because I think I've compared it to Superblis, for example, being $1 billion business, that's fine, but their gross profit's very low, right? So the point is, it's like just looking at revenue as a number in itself and saying, oh yeah, I'm a unicorn business. It's a very different game in terms of what you're looking at in terms of how much money are you actually taking out of the business at the end of the day. And the point there is like, this is why it's so difficult to be a unicorn software business, because think about the proportion of profit that's coming from that at the end of the day. And if we're in this VC game, we're looking at the software plays, you're 100% right. It is not possible to be a software company that can become a unicorn in South Africa alone. That is just the nature of it. And you need to expand geographically if you're going to want to be able to hit that scale of IPO eventually.
No, that's absolutely right. I mean, it's we've got, as I say, we've got a great place to build a business and prove to the world. We've got PMF and product market fit. I call it PPMF, not product market fit, profitable product market fit, because I've seen too many businesses tell me they've got product market fit, but they're losing money on every single deal, and they continue to lose money. That's not product market fit. It's like selling $1 for 80 cents. You have got product market fit because everyone's going to come to you and buy $1 for 80 cents. But you haven't got product market fit. You're losing money on every deal. And I see this too often amongst our entrepreneurs. I've got product market fit. And I can go into that topic if you want to about, false positives and false starts. And I've seen it too often, entrepreneurs saying they got PMF. They're not even close. Their churn rates are too high. Their lifetime values are too low. Their cost of acquisition is too high. That's not product market fit. You're just selling these things cheaply. Like I said, you're giving the $1 for 80 cents. Yep. You don't have PMF. But let's go talk about geographical expansion. I see, and what I've done is two major ways of doing going global. One is through partners. So probably if you've got good partners locally, you might have the same partner globally. So let's just say the partner's Accenture, the partner's IBM, or the partner's Cisco, whoever it might be. They might have global offices all over the world. And you can actually partner with them. They are selling your technology because it complements their suite of technologies. And you can actually just set up a partnership in the US, set up a partnership in the UK, set up a partnership in Singapore and other parts of Asia, and you can actually expand that way. In addition to that, the other way of doing it, and if I look at Senmark, they've done it in both ways, is you set up an office in a different geography. So they wanted to go into Amsterdam. So one of the founders went to Amsterdam. He hired one or two other people, but they've just got a very, very small office in Amsterdam, but they're doing a lot of revenue. All the software development, tech development is still done in South Africa. A lot of the sales is still done in, not sales, but like the SDRs or the inbound, outbound is still done in South Africa. The actual sales, so typically you hire a sales manager. Now you can call it a general manager, but typically when I've taken businesses globally, we've started with one person, which you can call it a general manager or a sales manager, but they're responsible for sales. So they start getting sales in that geography. So all the support comes from South Africa. And as it starts scaling, you start building and hiring a full-blown team there. You might even start developing the RP offshore because of RP laws. But typically, you don't have to, it's very expensive in dollars or euros or pounds, whatever it might be, to go global. But you don't have to spend a lot of money. If you want to go to 10 countries, like we've done with Denmark, we started with a sales manager in each of those countries. And once they've gone bigger and bigger, yes, we start hiring a sales team and things like that. But to get going, it doesn't have to be that capital intensive to get going. So it's through partnerships, or it could be partnerships, and you still need someone on the ground. Even with partnerships, you still need someone on the ground there that's managing the partnership, because people buy from people at the end of the day. They don't buy from companies. So you've got to form that consultative relationship. You have to help the partners grow, help the partners understand what the technology is, and you have to incentivize them properly, because most of these big partners, take Dimension Data, that's one example that Denmark has got. They've got 50 products they're selling, and you number 51. You want to move number 51 to number 1. And the way you do that is two ways. One is you spend a lot of time onboarding them and training them. But secondly, what you do is you spend a lot of time in motivating them by, if they sell, every time they sell, you'll give them additional 20, 30% on top of what they're getting already at their company. I've got my own company. I won't mention the name, but we should hopefully be selling. It's like the Shopify of Africa. It's exactly a Shopify. It's got everything, all from the e-commerce side to marketing, sales, social media, logistics, payment gateways, everything. So it's got everything. And we now in about 15, 20 big companies, like the likes of VodaPay and the likes of Standard Bank and all these that have got huge distribution. And we're leveraging that distribution to go all over the world. And it's unbelievable. I mean, we've just raised capital at an amount that was, wow. I mean, my money is like 15, 16 times what it was when I invested. This is my personal capital, what I invested when I made that investment. And this is really done completely through partners. It's done through partners where we've got a couple of sales guys that travel around the world and help them. But the point I want to make here is we, on top of their own sales commission, we onboard them. We've got a lot of really good trainers and onboarders, but then we give them an additional commission if they sell our technology. So suddenly, it's not 51 anymore, it's number 1 because they're getting more comp. You got to understand, salespeople are motivated by money. It's simple. It's nothing wrong with that, but they're motivated by money. That's why they're salespeople. So the more you can pay them, the more they're going to sell your product rather than selling someone else's product. So going global is not rocket science. It's not rocket science. Another business in Kalon where it sells, it's like a marketing business. It does personalized websites. It's a business called Mobus. They internationalized. The CEO went to Atlanta to start the business there. And really what he's done, he's hired just a few. He started with a sales manager. They're growing very, very fast. It's already quite a few $1 million they're doing in the US. But now they're hiring sales managers, chief revenue officers, salespeople, SDRs, BDRs, sales development reps, business development reps, biz dev, and getting into a lot of partnerships and growing the business. It's incredible. They're just about going to catch up the American revenue to the South African revenue, which was a 5-10 year business. So not rocket science going overseas, but what I would advise anyone listening, don't spend too much money on doing it, because you can piss away so much money. You can raise your Series A, or even better, Series B, because Series B is typically about product expansion or geographic expansion. But you can raise that Series A, Series B for geographic expansion. And if you do it too quickly, you can basically destroy it. You have run out of cash, you're spending too much money, and you can run out of cash. And when you do run out of cash, which is a lot of businesses from 2021 where they raise all this cash, and now the investors are saying, well, it's either a down round, a flat round, or I'm not investing. So you read the press, Cameron. Businesses are closing, tech businesses left, right, and center. And they were the ones that raised too much capital a few years ago. Ridiculous valuations, raised too much capital. The investors are not seeing the traction. They still got 2-3 years to work into that valuation, and they refuse just to put more capital in. And when they refuse, your current investors refuse to put more capital in, to get other outside investors or external investors where your current investors don't invest, very, very unlikely in the VC space. VCs are clever. They're not fools. If your current investors are not going to put money in, I haven't got any money, and oh my God, I've heard all these excuses. I'll tell you, they've got money. They just they choose not to put their money into your company because they've got great companies. They've got the companies growing at 100, 200, 300% per year. Why would they put it into a company that's not growing? I wouldn't do that. If it dies, it dies, and I'd rather lose that money than throwing good money after bad. I'd rather put into my winners than back my losers. And so I've heard from a business the other day, not one, but another business, not the one I'm investing in, that the investors have got no more money. And I know these investors, and they've got fortunes of money. But they've decided not to. I said, well, what's your growth? Oh, about 1% a year. I said, okay, I get it. They're not going to put more money into business.
You are literally 1% per year is entropy. Like you are going to die if you're growing at that rate.
But even 1% a month or 2% a month, that's not a venture capital investable business. I mean, do you know the triple, double, double, double? Have you heard of that number we use in VC?
No.
So basically what it says is once you get to $1 million, so it might take you a couple of years to get to $1 million because typically initially you're spending a lot on R&D and you're spending a lot of writing your tech and you're not actually doing a lot of commercial stuff. But once you get to $1 million, the first year you triple that million. So you go from $1 million to $3 million. And that's about 10% month-on-month growth. That's great growth. Then you go 3 to 9, triple, 9 to 18, 18 to 36, 36 to 70, 72. So that's triple, double, double, double. Now, if you get, and I've got a business that is a triple, double, 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 there's no shortage of capital chasing this business. They can raise whatever they want to raise because they're in the top 1%, not even the top decile. They're in the top 1% of venture capital businesses around the globe. And those are the businesses that typically will go to an IPO when you can actually do that. Yes, after your 72, you then slow down to maybe 100%, just double. Then you go to 70%, 60%. But that's fine for a VC. You understand it. $100 million, you're not going to go to $200 million. You might go to $160 million. That's exceptional growth. When you get a bit later, your growth percentage will go down. But when you're a small company, we look at triple, double, double, double. And that's a global VC thing. That's not Clive's. I learned this from when I spent time in Silicon Valley. I learned this from the experts there. And I swear by it, And that's only a 10% month-on-month growth. Is that impossible? Not at all. If you really got product market fit and the dogs are eating the dog food and your systems are starting to break because there's such a demand that you can't supply enough of the demand. If it's a tech business, you're providing more and more service and more service, and you're adding to these servers the whole time, and it's breaking because you got this demand. You got product market fit. Not before that.
Yeah, it's a good way to look at it. Sure, Clive, I'm going to summarize what you've said. I want to just talk about the partnerships and geographic expansion in a bit more depth, right? I might go on a little bit of a monologue, so warning the listeners and viewers here, and I'm going to get a bit conceptual. But you've spoken about horizontal integration through partnerships in terms of being able to expand that way and to increase market share through someone else's scale and size. And then the geographic expansion. I think the main point there is either way, at least in my belief, is that you need to have a stable core business before you employ either of those, right? Is that the point you need to just keep growing in your core market. You have a stable core business with good systems, good structures, solid management team, and its ability to grow itself. The reason why is because once you start going down the route of partnerships and especially geographical expansion, I think the point of geographical expansion that you made is not necessarily being rocket science. And the reason why it's not is because if you're ready to do so, what you're going to be doing is almost repeating the process in a new country that you did within your core market because their market's fundamentally different. So the point there is it's like, what are the customer needs? What's the market needs? What are their pain points? What are their preferences? So how do I tailor my product to them? The fact that it's not rocket science is you don't have to completely rebuild the product. But the point there is the fact that you need to completely reposition yourself in that market and re-understand that market in order to do that, which is in many ways starting from scratch. The problem is that if you don't have a stable core business, what you're going to do is you're going to be so distracted by how much you need to learn within that core market that you don't give your original business the attention it deserves. And now both of them then the core business starts to taper off in terms of its growth. And now you don't have the bank that you can lean on in order to afford the capital and this attention that you need in order to grow the other business. So this is a point that I like to echo many, many times is the fact that it's like you until you have a stable core business that is not dependent on you as the founder, you should not be looking at expanding geographically just yet because you're actually just going to slow yourself down. Vusi Sembakwayo gave a very good metaphor in terms of the fact that is don't something around like don't sacrifice your wife for your mistress in terms of your growth and looking at that. So that's how I think about it. But then even one level beyond that is de-risking that even further is doing that through partnerships. And the way I like to look at it is this is the benefit of also staying super niche. Because staying super niche, you can grow in your core market, you can become successful, you can grow quite quickly and become a stable business that's not doing too many things and too complex too early. You can make that stable before growing. The other benefit of being super niche is that you can look at your value chain and look at who are these larger businesses that we can then plug into. An example that I'm actually giving in terms of a masterclass at the South African Startup Club is a logistics startup, right? A logistics tech startup. I've completely made it up, But the point there is that what they do is they do route optimization for e-commerce companies with their built-in logistics. What would be an ideal partnership is going and partnering with Shopify. So Shopify now is like, once anyone who's got Shopify as an e-commerce business, what's an immediate point in terms of the value chain after that is that now the logistics and the delivery. So if I can partner with Shopify to plug in my product to their clients around how is it that so that they can now go and actually deliver this with a route optimization system, I scale this through the absolute roof. And I'm not only adding value to their clients, I'm adding value to Shopify as well, because it just improves the robustness of what they're able to do. That's the example that I've given. It's the benefit of partnering there. And that can then accelerate your ability to go geographically because they are already in those markets and now you don't have to do those learnings. And I just love the examples that you've given. And I just wanted to give the conceptual side of things in terms of, well, at least that's how I think. I'm curious to know who else thinks that way. But just to really summarize how to go about doing that growth.
But Cameron, let me just stop you there. Sorry, can I just stop you there for 1 second? I just
Sure.
want to add to what you were saying and something I omitted to say. I think it's very important to understand, because you've got product market fit in South Africa with product A, it doesn't mean you've got product market fit in America with product A. That's your point you were raising. You have to get product market fit again, because your ideal customer profile you're selling in South Africa, it could be your marketing director, that could be your sales director there, it could be your CFO, it could be anything. And so, I mean, if you take a very well-known, not going to name it, but a very well-known South African marketplace, went to Nigeria, spent a lot of money, didn't work, recalled the whole thing, switched it off, spent a fortune of money. And the mistake they made, in all honesty, was assuming because it worked in South Africa, it was going to work in Nigeria. And the second mistake they made is they built this big team too quickly before. And they spent so much money, which cost their shareholders an absolute fortune. And I'll tell you something, sadly, I see this every single day. It's exactly what you said. You haven't buckled down your first product. You know, product market fit, if you think about a product market fit, it's a repeatable and scalable and profitable sales model. I'll say it again, repeatable, scalable, and profitable sales model. And until you've got that, that's when you've got that. It's repeatable, it's scalable, and it's profitable. Then maybe you've got product market fit that you can start either, you go to vertical integration, which is more products, or you go to horizontal integration, which is more geographies. But every time you add a geography or every time you add a product, you add so much complexity. It's like to the power of. It's not 1 + 1. It's 2 to the power of 2, to the power of 3, to the power of 4. That's the complexity. And I know this from building my own businesses. Sometimes we go too quickly. My one business that I have in Kalon, this guy decided to go to 5 geographies before he had product market fit in one in South Africa and lost every single cent too quickly. And now he's ready to go into the geographies. But we say, no, we've got a small percentage of this market. We've got a couple of percent. Let's get 10%. I believe saturation is at around the 10% mark. When you get to 10% of the total target market, that's the time to start looking at going, geographically further, because that's a big piece of a market. If it's a market, it's R1 billion, you've got 100 million, good time to start looking to take it to new geographies. So don't forget, for the entrepreneur, you have to find PMF and that repeatable and scalable and profitable sales model every single country you've gone into. And this is no different whether you Uber, whether you Airbnb. They've all gone through this. They've all gone through these growing pains. In all honesty, they've all gone through it. They've tried to go too quickly. The investors put them under pressure. Spend. Go into all these markets. And all they did was cost themselves a bucket load of cash. And some of them, as you know from we've seen the movies, nearly ran out of money. Or did run out of money, because that's what they did. And you have to be so careful of the complexity. And as you said, if you're a single founder, I don't like backing single founders, just so that your listeners know. I like, if you look at percentage-wise from Y Combinator, majority of their businesses are 3 founders. Second majority are 2 founders. The least is 1 founder. And if you look at the success rates, 3 founders and 2 founders are significantly more successful than 1 founder. And it's obvious, you've got no one to share it with. You're a single founder. You're trying to take it on yourself. You haven't surrounded yourself with the right types of people, with the right types of founders. I like backing 2 or 3 top companies that have got 2 to 3 founders. I'll tell you something, I've had the best returns when I've backed those sort of founders.
Yeah, 100%. So I totally agree in terms of the founding team. But Clive, just to take a step back to the point around product market fit, and I think this is where anyone can be guilty of, because I think this is just a normal part of being human. But when we get product market fit, we've worked so hard to get to that point that now we have accomplished one of the biggest goals that we've ever set out for ourselves as entrepreneurs. And when we achieve that, it comes with this confidence that can actually potentially be arrogance, because when we look at product market fit, we think product market fit instead of product market fit. And I've used that inflection deliberately in terms of the fact that because depending on which market you play in, the products can be almost identical, right? And so the problem there is when we think about product market fit is like, okay, we got the product to the point that it fits the market, instead of understanding the market well enough and tailoring the product for them. And the problem there is that product market fit only works in one market. The moment you enter another market, you don't have a product market fit at all, even though you've got the same product. You need to tailor it for that market as well. So I'm very glad that we got to illustrate that point in depth. So Clive, now to the next point is we're talking about growth, we're talking about scale, geographic expansion. It's like these are all good and well, but also as entrepreneurs, we also know is like you can't do this if you don't sell. That is the only thing that's going to generate growth, right? We talk about product market fit as a scalable, repeatable, and profitable sales model. Did I get that right?
Yep.
Right. So talking about that sales model now, right? How is it that we can go about improving the way that we sell, and how does selling change as we scale?
I think for one, we have to understand what type of business we're in. So if we're in an enterprise business, you're going to need a direct sales force. If you're in business to consumer, it's more marketing play than a sales play. You know, if you've got product-led growth where you're selling off the internet and people are using a credit card and they're buying, you don't necessarily need account executives, but you're going to need a support team that helps those customers on board. But sales is not going to solve that. Sales is more enterprise, whether it's software as a service, whether it's a platform business. But as soon as you're selling to enterprises, you need to build a team. The first person I've always hired in businesses that I've grown is a chief revenue officer. So that's something that revenue officer has got everything to do with sales and marketing and customer support and all the sales operations, everything to do with sales is that underneath that chief revenue officer. But if we don't do it that way, so the person that's going to sell initially, your first 10, 20, 30 sales is going to be the founder. It's founder-led sales. The founder's got the passion. The founder understands the product. The founder can sell. Even if they're not good salespeople, I'll tell you, they sell on their passion. They sell on their vision. That's the best you can do is founder-led sales is for the first 20 to 30 sales. Once you're at that point, you're now ready to start hiring a sales team. And you have to have found that repeatable and scalable, profitable sales motion before you start hiring a sales team. Because if you haven't got product market fit and you start hiring a sales team, that's just going to push money down the drain, in all honesty. Because how can they sell something that doesn't work? You're showing them what's work. You're showing them the systems and the processes and what's the value proposition and et cetera, et cetera. So it's just not going to work. You have to have that PMF in place first, and then you start hiring your two. And I like to say two salespeople, just because if you only hire one, if they don't perform, you don't know if it's the product that's not performing or it's the salesperson that's not performing. If you hire two people and one performs and one doesn't, it's not a product problem. It's a people problem. So you start out with hiring some. Before you hire a sales manager, get some salespeople that can get this repeatability in your process. You're not paying them a fortune, and you can start your sales team with that. Once you've grown that, then you hire the next two. Maybe you've got 6 salespeople. Probably that's the time you hire. And some of those could be account executives. So they quota-carrying people. So the numbers that I've always used in my businesses is in an enterprise business is about 5-1. So if I'm paying them 200,000 Rand, let's say I'm paying them $1 million. I'll give you the example of what's happening in America. So we're paying them $200,000. That's their total cost to companies, $200,000 that's including their comps. So it's 100,000 guaranteed and 100,000 is based on commission. Their target quota is $1 million. So it's 5-1. So they get paid, if they do $1 million, they get paid their 100,000 Rand commitment and another 100,000 Rand. So they get $200,000, which is a 5-1. Now, in earlier stage companies, you're not going to achieve 5-1. You'll probably achieve hopefully 3-1. And 3-1 is getting to your target customers. Less than 3-1, I think you're in a little bit of a dangerous territory. But once you mature as a company and you're in Series A, Series B, you want to be hitting that 5-1. So every salesperson that you've got an account executive, paying them $200,000, you want them to deliver $1 million. And you made the point earlier, this $1 million is not revenue. It's not revenue, it's profit. It's gross profit. So if you're only in a 50% gross profit business, which I will not invest in, I don't like those types of businesses. I like the 90-95%. Because if it's 90-95%, it can be revenue. Because it's the revenue and the profit are the same, so it's irrelevant. But if you are in a 50%, I do have a business in a 50% mark, we take gross profit, we don't take revenue. Because it's very, very misleading if you take revenue. Because you're actually not paying 5, you're actually paying 2 or 1. I mean, the economics actually don't make any sense. And then once you've got this, once you've got your account executives that are quota carrying, you grow that quota carrying. So maybe some focus in Durban, Cape Town, Joburg, and then you start doing that overseas as well. Then you hire a sales manager. And the very important thing about hiring a sales manager, and I used to head up sales for not only Accenture South Africa, but many countries globally, is these sales managers come in and they come from these big companies and they're actually order takers. They're not order makers. They got like a little book, like if it's Cisco, one of those and two of those, three of those, four of those. No. I'm not hiring order takers. I'm hiring order makers that you can create an order. But a lot of them come in and say, no, I'm not selling. I'm not carrying a quota. I'm not taking a commission. I'm just going to base it on my team. If they hit their numbers, then I want to get my commission. I'm not interested. It doesn't work for me. When it's a $100 million company or $200 million company, that might be different. But when I'm a 10, 20, 30, 40 people, 50 people company, I want them, for one, they must deliver the numbers of the team, but secondly, they've got to carry a bag. They've got to go and not 100% of their quota. Let's just say in the example of I pay them $200,000 and give them $1 million. Maybe they do $500,000 of their own sales, and the other $5 or $1 million comes from their team. And a lot of people don't get this. A lot of people make a cardinal mistake when they look at sales. They don't know how to measure these salespeople. They don't understand that sales solves everything. Nothing starts till the cash register rings. So if you can have the best product in the world. If you can't sell it, I tell you, you don't have a business. I tell you, you can have a very mediocre product and you can sell it, you're going to grow a big business. And there's many mediocre products out there that are very big companies because they are exceptional salespeople. So sales is more an art than a science. It really is. And you have to have done it before. And I'm very privileged that I've done it all over the world, working with unbelievable companies in there. I helped grow Salesforce from $1 to $100 million. That's where I worked, growing it from a $1 to $100 million business. It's amazing what I learned in actually doing that. I'm talking a long time ago. It's a hell of a long time ago. But people need to understand, get the expertise of how do I set up a sales team? How do I balance? Because you've got to think about this now. When you start a business, your first $1 million, most of that is founder-led sales. And if you raise capital, you're raising, seed stage or pre-series A, most of that capital is actually going into research and development. 70% R&D, maybe 10, 20% sales and marketing. Very small percentage going into, because you have to build world-class products first. When you're at that now $10 million, let's give an example now. Now it switches completely. I've got the products now. Now I'm spending 70% on sales and marketing and 20% on R&D. I see too many businesses, and one of the businesses that I work with closely, $10 million business and still spending 70, 80% on product development and they actually lost their way. They had a true RCP. They had a brilliant product market fit. Instead of just doubling down and selling more and more of that product, they built 5 more products and spent, I think it was 6% on sales and marketing. The business took a huge knock. And I've tried to explain it to them, spend more on sales and marketing. You don't have to build 10 products, build 2, sell them. Build 3, sell them. Spend the money on sales. No, 5% on sales and marketing, 70% on R&D. They grew at 5% the whole year. I mean, at least they grew. But this is such a common error that I see made. And that's what I go into these companies and I say to them, no, where are we now? Where should we be spending? What does that organizational structure look like? Much more goes into sales and marketing. If you look at the IPO companies on the NASDAQ, go and look at their financials, see where they're spending their money. You'll see a large portion of their money is going into sales and marketing. It's not going into R&D. And this is a 100%. Complete flip around. And that's why I said the skills are so different that you need when you go from $1 to $10 million or $100 million than you do from 0 to 1.
I couldn't agree more, Clive. And I think just to explain and why this is also, for me, normal. And just because something's normal doesn't mean it's good or right, by the way. But it's very normal because a lot of these founders they're experts, right? It's the same thing for me. Is like we've built expertise and specialization and strategy. I think we've still got a long way to go. Don't get me wrong, but the point is, it's like, what is it that we would love to do? Especially Brett is my business partner. We love to the amount of time that we have wasted just discussing the semantics and complexity of strategy models and tools and methodologies and wording and how to do this is because we love the expertise of it and we like building it and we like solving the problems around this. Same thing with tech founders. A lot of them, they love the technology. They love to build the product. And so what happens when you find product market fit, what we some people are aware of, but some people are not aware of, is that what happens when you hit this first ledge of success is like, okay, now I can reward myself by doing the work that I want to be doing. You've gotten to that point now, but it's like, okay, I'm a tech founder, but I've learned to also be a businessman and a salesperson doing all that. And now I found product market fit. Now I can actually go do the stuff that I love and just building any idea that comes to my mind, which is very seductive, but very problematic. And it's very normal if that's your natural inclination. And I think this reinforces your points around why the best founding teams are 2 or 3 people. Because there, if you're a one-person team, you have to be the product. You have, in the gross simplification of it, you're the product, you are the people, and you are the sales. You have to do all of those. And if you've got a leadership team of 3 people, you can have one person focusing on products, and they can do the R&D until they go blue in the face, right? And then they can just make it better and better and better. But as long as you're allocating your budgets in the right way as a leadership team to have perspective, then fine. But that's what they're dedicated onto, and they can optimize the absolute hell out of it. And if they've got extra time, maybe build some passion projects to keep them motivated. You've got the sales and marketing person who's actually just there, the face of the business, engaging with customers, building in revenue, we're bringing that in. That's chief revenue officer, chief growth officer, whoever it might be. And then you've got the people, the structure, the operations person who's actually trying to place it all together and making sure that the actual business runs. And I think that's the problem there is it's also where, as you scale, that leadership is actually just a function of a company. It's not a person. And so the point there is building out that leadership is making sure that you're allocating your resources in the right direction to achieve growth, and just making sure there is that a lot of these founders, what's fun and what's sexy is solving problems and building things. What's boring is, okay, we found product market fit. Now we just need to repeat everything that we do that we know works and make a hell of a lot of money. And it's so counterintuitive, because that's when you start becoming successful and generating a lot of cash. But for a lot of entrepreneurs, that's ironically the boring part, because it's no longer chaotic and it's no longer problem solving. And that's when I think a lot of founders struggle, because that's when the most discipline is required. Is the fact that you need to control your impulses. You need to focus on just, it works. Like we're naturally innovators. We're naturally problem solvers, but it works. Stop innovating it, right? Stop trying to make new things and just keep selling this until such point that this is stable, and then do the new things afterwards.
One of my mentors taught me, and I'll never forget this. He said you need 3 types of people in a tech business. You need the hackers, the engineers that can hack the code. You need the hustlers, the sales guys that can go and sell the stuff, and you need the hipsters that can design an unbelievable, they can talk to the users and they can talk to the engineers and they can design the best product you've ever seen, the UI, the UX, etc., etc. So when I make an investment in a business, often I meet with engineers, and there's 2, even if it's not only 1, 2 engineers, and I say, guys, where's your commercial person? Where's the commercial person that's going to be able to take the brilliant that you're doing and go and sell it? And no, we haven't got that. And so often I see these businesses so struggle to get the commercial savviness in the business. Because what do engineers like to do? Engineers like to build. And they build. And I say, well, have you gone live? No, it's not quite ready. I say, well, when are you going to go live? No, got to build these 2 widgets, and this is not 100%. Get the thing out there. As Reid Hoffman says, if you're not embarrassed about your product, you've released it too late. And they just love building and building and building. So I like to have a 2-man team or 2-woman team or a team. Someone who can build the stuff and someone that can sell the stuff. That's the absolute minimum. You need a builder and you need a seller. And if you find that, you've got a great, and often it's more than 2, but just a minimum. The engineer that can build the best tech in the world, and the seller that can sell that unbelievable tech. That's the interface between the team and the market. And they can really understand customer needs and then develop a product for the customer needs. So, there's something so great they taught me as well. They call it a T-type entrepreneur. So if you look at a T-type like this, you've got you've got the horizontal that's like 1 inch deep, and then you've got the vertical that's a mile deep. And that vertical is deep expertise. You're a specialist. You are the best finance person you can possibly find. You're the best engineer you can possibly find. But typically what you find in the first 10 people in a company, you find generalists. The first 10 people you hire, I know when I built companies, the first 10 people I hired were just generalists. They weren't the best sales, marketing. They just knew a lot about sales, marketing, product, finance, engineering, everything. They knew a little bit about everything. They didn't know a lot about anything. But when you start growing from 11 to 50 to 100, you've got to start hiring specialists. So the generalists start hiring the specialists. They hire the best engineers. They hire the best product designers. They hire the best marketing people. They hire the best salespeople. And that's the difference. And that's the difference in the operating model or the org design that you need from the 1 to 10 to 10 to 100 to 500. You are hiring specialists. You're becoming a corporate. When Standard Bank hires someone for their organization, they find the best person in Python to develop Python code. That's what they do. You do the same as when you start scaling to a 500 people organization. So you have to start out with generalists. Your founding team and your first 10 hires are generalists, and then you hire your specialists. And often what I found, and I still find it, the expertise of the founder. Let's just talk about one founder for a second. I'm not going to mention the name, but he's a marketing guru, absolute guru. And the strength of the founder becomes the weakness of the business because he never hires marketing. So he says, no, we cover this area, no problem. We don't have to. We'll hire finance, we'll hire everything else, and they don't hire the founder's expertise. And it becomes a major, major weakness of the business. And it's funny, I remember when I got taught this by one of my mentors, I thought, no, I don't think that's really true. I tell you, I've seen it in every business. Absolutely true. The founders don't want to hire where they're good, and it becomes the biggest weakness of the business.
Yeah, you're so right. So Clive, I think that's a good segue into... We mentioned the 5 C's right at the beginning, and we spoke about coachability. But in terms of having the best founders and the most investable founders, take me through the 5 C's real quickly.
So we've spoken about coachable. I won't go back there. The next one is communication skills. You need to be able to communicate. When you're a founder, you've got to be able to communicate with investors, customers, employees, the press, everyone. I find too many people and founders that just can't communicate. They can't communicate their ideas. They go from A to Z to B to C to D, and it's so hard to follow what they're actually trying to say. And doesn't make them not less clever or anything like that. They're geniuses, but they're just not good communicators. So you have to be able to communicate. I mean, the third C is charisma. If you need that charisma in the sales team. I don't think I'm looking for an engineer that has to have charisma. They're stuck writing code, it's fine. But someone in that team's got to have that charisma. They can go to the market and they can convince people to buy into their vision. That's a lot of charisma. The fourth one is curiosity. When you're a founder, you've got to be curious. You've got to know what the competitors are doing. You've got to know everything about what you're doing. What are they doing? What's the market doing? You've got to just be a learner. Just keep on learning and learning and learning and learning and learning. You hear a new word, go out there and learn. If you're in venture capital, there's so many terms that you have to learn. If you're curious, you'll go and Google it. You'll go into ChatGPT. You'll go into any, AI type, and you'll find out what it actually means, what it does, what it is. So curiosity is a very, very important attribute of a founder. Because if you're not curious, you're not going to grow. You're not going to grow as a person, and your business is not going to grow because you're not going to know what's coming. You're not going to know what the competitors are doing, and you don't have to be obsessed by the competitors. But get to know what they're doing. I call it R&D, rob and deliver. You don't have to start everything from scratch. Just go, if they're doing it and it's working, just do it yourself. Just be curious. And then there's that courage that you need. As a founder, I've got a situation right now, another one of the businesses that I'm working in, that this founder is a lovely guy, but he hasn't got the courage to fire someone. He knows they're the wrong people. They're taking a lot of money. They're sucking his energy out of him, and he's just hasn't got the courage to fire this person. You need courage. Fire fast, hire slowly, and fire fast. You have to do that. And he just will not fire this person. So what do I hear from him? No, but he's good at this, he's good at this, he's good at this. And I say, okay, he's a salesperson. Give me his numbers. No, he hasn't sold anything. So, well, it's been 2 years now. He's still sold nothing. There's a problem there. Get rid of the guy. No, but I can't get rid of him. So you need to have courage. And I mean, if the 6th C is just commitment, The problem with a lot of entrepreneurs, it's hard. It's so hard. You know that, Cameron. One day you wake out of bed and you just say, no, I'm staying in bed. I'm not getting out. Yeah. And that's the problem when you find founders with too much dilution, when they're sitting with 8% of the company and you haven't got to Series A. Why would they wake and get out of bed? So I won't invest in a company, and unfortunately, some early stage investors take 49, 50% of the company. That's those poor founders, they 3 of them, they're left with 16% before they've even raised their pre-Series A. I'll never invest in a company like that. They're just not motivated to succeed. So it's a pity, but a lot of angel investors, and I see it all over the place. Yes, they're putting their money, but they're taking half the business, and they're leaving the founders with nothing. So they've got to have that commitment. You have to have that commitment to get out of bed and just never stop going. If there's a wall, find a way to flying over it, get a drone, build a tunnel, find a way around that wall. And that's what I look for, those 5 or 6 C's I look for in an entrepreneur.
Clive, thank you so much for sharing. Thank you for all the wisdom and the lessons that you've shared on the podcast. It's been absolutely unbelievable. Usually at this point, I'll ask, what does the future hold for you? But we spent so much time talking about your vision for Conducive and for what VC looks like in Africa and South Africa that I think we've done that justice. So I'm just going to end off with the question that I always end off with, and you know it because you're also very glad that you're an avid listener of the podcast too. But what is the one question that I haven't asked you that I should have asked you that you'd like to answer now?
I'm going to say, what's the biggest challenge entrepreneurs have around raising capital? What's their biggest weakness? And their biggest weakness is they don't understand their unit economics. They don't understand their financials of their business. Warren Buffett said accounting is the language of business. So if you don't understand the metrics of how your business is managed, whether you're a marketplace, a fintech, you're a SaaS business, you're a business to consumer, business to business to employee, whatever it might be, there's certain metrics you have to know. Revenue growth, churn, lifetime value, sales effectiveness, burn multiple. And I could go on and on and on and on and on. But I asked them, okay, so tell me about your GPs. I'm not really sure my GPs. I said, okay, go and find out. They come back and say it's 80%. I said, what's in there? What's actually in there? So where's your cloud hosting cost? No, that's not in my GP. But I said, but you're an AR business. You want your cloud hosting costs in an AR business or one of your biggest expenditure of COGS, of cost of goods sold. Oh, I should put that. So actually, they tell you they're running an 80-90% gross margin, but when you actually lift the hood and you do your duty, they're running a 40% gross margin business. You have to know your numbers. And it's not about, let me call my accountant. No. You don't have to know about a general ledger. Understand your income statement, understand your balance sheet, understand your cash flow statement. Understand, if you look at your income statement, what is research and development? What is your GNS cost? Is your SG&A cost? What is your R&D? What is your sales and marketing? You have to understand those ratios and how your unit economics are built up. What's your lifetime value? What's your cost of acquisition? If you don't know what it's costing you to cost the customer, how do you know you're making even money? I'm seeing businesses grow themselves out of business because they've got the top line growth, but they're actually not making money. So they grow themselves out of business. It's a terrible thing to see. They just grow, and then they got no more cash and they actually close the business down. So know your unit economics. That would be my lesson.
Clive, thank you so much. I think this has been so jam-packed that I would listen to this multiple times myself. It's been such a privilege to have you on the show, and I can't wait to see what you're able to achieve with Conducive Capital, and I'm so excited for that R1 billion fund to hit the market.
No, thanks, Gabriel. Thanks for the great chat, and have a great day.
Sure. What an episode. I'm still reeling from the conversation, just the pace of it, how much we went into, and I'm sure you are too, but I've just got a few reflections, as I always do. And the first one is just how hard the venture capital business model is, and how patient anyone in VC needs to be. I think it can be incredibly rewarding, both financially and motivationally, if you get it right. But VC is far more than just being an investor. VCs are in the business of building businesses, which requires far more than just capital. I mean, I think of myself though, and just from a capital perspective, I'd much rather be an LP than a venture capitalist. And what that gives me is a lot more empathy and respect for the general partners in venture capital firms because of what they're doing and how hard it is and how patient they need to be. So I plan to be a lot more curious now to really understand them and how they operate. And I look forward to doing that on the show with you here so that you get to share in those learnings too. Secondly, it's less of a learning, more just a reinforcement and a reminder that South Africa as an economy is quite small. I mean, we spoke about the lack of VC funding, but also if you look at the startup opportunities, they're quite limited. So it's inevitable that for us on our growth journey, we'll need to expand geographically. And with our kind of business model, the best way to do so will be through partnerships instead of just going into new geographies ourselves. I mean, we've already done this by working with some Pan-African accelerators, but we're going to have to continue to search for partnerships in the future that can give us solid footholds to grow into new regions. But when, and only when, we've got a stable core business here at home. I definitely plan to walk the talk of that one. Finally, it's Clive's 5 C's of coachable, communication, courage, charisma, and curiosity. What I find quite interesting and uncanny is that when we first started Metavolve, we identified our values as courage, curiosity, compassion, and candor. And it's so interesting for me that what Clive values so highly in founders, myself and Brett intrinsically valued so highly in ourselves. And look, I still think that we've got a long way to go, but it reinforces that our principles are in the right place. And the lesson that I'm taking away is to just further embrace those principles and translate those into skills. One example is that I get a huge benefit from doing this podcast and the ability to fine-tune my communication skills and my curiosity by constantly learning so much from other entrepreneurs. I just need to find ways to keep being more open and coachable and courageous and the different contexts for that. And if you figure out how I can be more charismatic, if you have some feedback for me on that one, then please let me know, because I'd love to hear it. But for now, that's it for me. Thank you for listening to another full episode of The Founder Files. It means the absolute world to me that you enjoy the content so much. I hope you keep sticking around, and until next time, cheers.